You don't really borrow money. That's the first thing to understand. When you take a loan, student loan, mortgage, car loan, credit card, you think you're renting money for a while. You think the price is interest, a percentage, a number. But interest is not the deal. It's just the cover charge. The real agreement is quieter, older, and far more consequential. And once you see it, you'll never hear the word loan the same way again. Because every loan you take isn't just about money, it's about time, leverage, and who gets to move first. Right now, global debt is over 3 times larger than the world's entire annual economic output. Governments, corporations, households, everyone is leveraged. Everyone is using credit. And yet, very few people can clearly explain what's actually happening under the surface. That matters because this system doesn't just shape your finances, it shapes your choices, your career, your tolerance for risk, your freedom to say no. So let's slow this down, not with formulas, not with jargon, but with the actual mechanics of the deal you enter every time you borrow. Because once you understand the hidden agreement, the incentives snap into focus, and the system starts to look very different. Start with something familiar. You need money, not for luxury, for something reasonable, an education, a home, maybe just to smooth out expenses while life happens. You go to a bank or a lender or an app. They approve you. You feel relief, gratitude even. You've been trusted. You've been given access. But notice what didn't happen. The bank didn't give you money it already had sitting in a vault. In modern financial systems, most loans don't come from existing savings. They come from money that is created at the moment the loan is issued. New money enters the system because you signed a promise. That's the first layer of the deal. Your debt becomes someone else's asset, and that asset earns a return. Now here's the uncomfortable part most explanations skip. When money is created through lending, only the principal is created. The interest is not. That means system-wide, there is always more debt owed than money available to repay it. This isn't a flaw, it's the design. The system assumes continual expansion, more loans, more growth, more future income pulled into the present. Which brings us to the real currency of debt, time. When you take a loan, you are not just agreeing to pay money back later. You are committing a portion of your future labor, work you haven't done yet, income you haven't earned yet, to someone else's balance sheet. The lender gets certainty. You get obligation. And this asymmetry is the core of the hidden deal. Because lenders don't need you to thrive. They need you to remain predictable. A steady paycheck, low volatility, high compliance. Debt doesn't just price risk, it shapes behavior. Think about how differently people act when they are debt-free versus when they are leveraged. Risk tolerance shrinks, career choices narrow, the cost of saying "I'll wait" becomes unbearable. That's not accidental. Debt is one of the most efficient tools ever created for converting future uncertainty into present control. And it works quietly. No coercion required, just contracts. Now zoom out. This same logic scales up from individuals to entire economies. Countries don't borrow because they want to. They borrow because global systems reward it. A government issues bonds, investors buy them, interest flows upward. Policy decisions start bending around debt servicing. At a certain scale, debt stops being a temporary tool and becomes a permanent condition. And permanence changes incentives. When debt must always be rolled over, the goal is no longer repayment. The goal is stability. Avoid shocks, avoid defaults, avoid anything that threatens confidence. Because confidence is what keeps the system alive. This is why markets react faster to fear than facts. A rumor can move billions. A downgrade can trigger a crisis. A loss of trust can freeze liquidity overnight. And liquidity is the oxygen of debt-based systems. Now, let's bring this back to your loan. You were told the cost was interest, 5%, 10%, whatever. But interest is just the visible price. The invisible price is optionality. When you take on debt, you give up future choices in exchange for present access.
You trade flexibility for immediacy. That can be rational, necessary even, but it's never neutral. Because while you are committing future income, the lender is not committing future labor. They are committing capital, a claim that can be sold, securitized, repackaged, or hedged. Your obligation is fixed, their exposure is flexible. That difference is everything. This is why financial institutions love loans that look boring. Mortgages, student loans, consumer credit. Predictable payments, long durations, low default volatility. They can model them, slice them, turn them into instruments. Your personal decision becomes part of a larger machine. And that machine doesn't care why you borrowed. It cares that you keep paying. Here's where the irony creeps in. We're told credit empowers people, expands opportunity, fuels growth. And in limited, targeted ways, that's true. But widespread debt doesn't primarily empower borrowers. It stabilizes systems. A heavily indebted population is less likely to disrupt the status quo. Not because they're weak, because they're constrained. A worker with no savings but high debt can't afford prolonged uncertainty. A country with massive external debt can't afford to challenge the financial order that funds it. Debt doesn't need force, it just needs continuity. And continuity favors those already positioned to extract value. This is why the system obsesses over growth. Growth isn't just prosperity, it's solvency. Without growth, debt becomes visible. Without growth, the math breaks. And when the math breaks, the power dynamics are exposed. This is where the public story and the private reality diverge. Publicly, debt is framed as a personal responsibility issue. Did you borrow too much? Did you mismanage? Did you live beyond your means? Privately, the system requires you to borrow. Stagnant wages, rising asset prices, basic necessities increasingly priced through leverage. Debt fills the gap between income and cost. Then we moralize the outcome. This isn't an accident. Shifting responsibility downward keeps the structure unquestioned. If debt is your fault, the system remains neutral. But if debt is structural, then the system itself becomes the story. And systems don't like being the story. Now consider interest again. Interest is often explained as compensation for risk. But in many modern lending environments, risk is distributed, insured, and backstopped. Banks offload exposure, central banks provide liquidity, governments intervene in crises. Risk doesn't disappear, but it rarely stays where the interest was earned. Which raises an uncomfortable question. If risk is socialized and profit is privatized, what exactly is interest paying for? The answer isn't just risk, it's access. Access to money creation, access to leverage, access to the future income of others. Interest is the rent paid to those who control the gateway. And gateways are where power concentrates. This is why financial systems don't collapse when borrowers struggle. They wobble when lenders lose confidence. The borrower is replaceable. The structure is not. Now step back even further. The global economy runs on promises stacked on promises, debt layered on debt, assets priced on expectations of future payments, markets moving based on projected cash flows decades out. It works until it doesn't. And when it doesn't, the response is almost always the same. More liquidity, lower rates, extended timelines. More future pulled into the present to stabilize the now, which quietly increases the scale of the hidden deal. Every cycle makes the system more sensitive, more dependent on calm, more allergic to disruption, more powerful in appearance and more fragile underneath. And this fragility doesn't announce itself with alarms. It shows up as anxiety, as pressure to keep moving, to keep producing, to keep servicing obligations that never fully go away. At the individual level, this feels like personal stress. At the system level, it's structural tension, and both are treated as normal. So what's the real deal behind every loan? It's not just interest, it's an exchange between present relief and future control, between flexibility now and rigidity later, between access to capital and submission to its rules. That doesn't mean borrowing is wrong. It means borrowing is never just financial. It's political, psychological, temporal. And the most important part of the agreement is the part no one highlights because it can't be reduced to a percentage. It's the quiet acceptance that your future has already been partially allocated. Which leads to the final question. In a world where nearly everything is financed, leveraged, and prepaid with tomorrow's income, who still owns the future? And who is just renting it month by month, payment by payment, hoping nothing goes wrong before the last installment clears?